Okay, so our next speaker is somebody who you will probably recognize, since he is often on the market shows on various TV networks and as well as on the radio. Matt Shapiro is president and CEO of MWS Capital. One of the interesting things about MWS Capital is that during the period this is during the financial crisis, during the period 2005 to 2010, they actually beat the S&P by 400 basis points, which is not too shabby. Matt is also a huge VIX trader, trading about 10,000 contracts per day. He is in the VIX pit. To relax, what he does, because he wants to, after the hecticness of the markets, he relaxes by playing his stereo full blast through some kind of technology that I don't understand, that he might explain to you. And if you ask him, he'll tell you who some of his favorite bands are. So, Matt Shapiro.
Page 1, please. So, are you guys ready to win? Win in today's market? Yes? Start trading? Well, the title of my talk is Winning in Today's Stock Market. Used to be called a classic approach. And as you see, a picture of Monticello, Thomas Jefferson's home, our first Treasury Secretary. Does the classic approach work? What does it mean? Well, if I got some guy in the middle of Illinois and he has $500,000, what do? It's this: Common Stocks, Uncommon Profits, published in 1958. Buy good stocks, young man. Hold them for forever. Buy good companies. But what I'm going to show you today is that the classic approach, while it may still work, has been superseded in all of our minds by what I call the catastrophic approach, the flash crash, where the probability functions of market participants, crucially, no longer work. Let's just touch on some brief recent instances. J.P. Morgan. Don't you think they have some of the smartest people in the world to manage their risk? Well, it didn't work. Let's talk about lending in the euro area over the last few years. People lent to third-tier euro countries at far, far lower interest rates than was reasonable. That's created the euro financial crisis. Let's talk about our own crisis, the United States lending crisis, when mortgages were written to people that were unsuitable, and the probability functions of the eventual derivative mortgage securities turned out to be completely wrong. So is there a framework to handle what is turning out to be catastrophic instances of probability function and estimation failure? Well, about the time I was born, there happened to be a very popular mathematical science that came out called Catastrophe Theory. Page 3, please. This is Salvador Dali's last painting in 1983. And what it is a depiction of what's called a swallowtail catastrophe. Somewhat idealized with the violin motifs and the like. But this is the work of René Thom and Christopher Zeeman, who postulated various bounded theorems that could describe natural processes where suddenly stable states shift into highly unstable and catastrophic ones. So if you look at this painting, it's actually a very good depiction of the set of outcomes that can occur in what Zeman proposed as a model of the stock market between bulls and bears and prices. So as you see, as the top of the S is a period of rising prices and complacency, and then as you slide towards this cusp, which is called cusp catastrophe theory, we move into a zone of instability where outcomes fold in upon themselves in an unpredictable fashion, finally falling to crashes where recovery is very difficult. Slide 9, please. Keep on going. Right there, thank you. So one thing to realize about catastrophe theory is that it's a dimensional catastrophe model in a bound and determined system, and it's not boundless. Participants' behavior and stress creates outcomes within the systems. That's why I believe with the latest mathematical tools, we can convert these dimensional catastrophes into better probability estimates. And the participants may not necessarily be able to forecast prices, but they will at least have a compass to define where they are. So what I've proposed is a 6-dimension catastrophe, which is defined as a parabolic umbilic catastrophe. There's 2 control factors, which is the level of stock prices, and secondarily, or behavior, excuse me, 2 behaviors, the prices of stocks and the volatility of stocks. Now, as we see in VIX trading, these 2 are entwined. When the market rises, the VIX almost always falls. But sometimes, of course, the VIX begins to diverge. And this can create a sense that maybe the market will turn. Finally, as you see, when the market falls substantially, the VIX almost always rises, sometimes hitting a zenith, but then tends to fall back when a recovery is imminent. So what you see is these 2 behaviors, the price of stocks and the volatility of stocks, are correlated but highly unstable. These are perfect dimensions for a cusp catastrophe model. Now let's talk about the control factors. Well, the first control factor, which I think is very important, is actual corporations. So realize, in the stock market or the bond market, at the end of the day, we're dealing with real organizations. Whether you're trading swaps or derivatives on interest rates or futures or whatever, at the end of the day, there's real companies and organizations that have a need for the capital markets for their whole, or self-preserving organizations. They have a need to raise their stock prices and optimize their capital structure. So in a classic model, the second part is, well, there's long-term investors. People like you and me who have retirement money, pensions, banks, even firms themselves. They work with companies to provide financing. They may believe in some sort of valuation theory, an efficient markets hypothesis, and the like. At the end of the day, they have to provide capital, and they want a return on their money. Now, there's 2 people that get in between this. Well, there's short-term traders. Short-term traders really have no need to invest. They're trying to just win for today. They see that there's a probability in their mind that the market may rise suddenly, they'll buy futures. If they see that a stock's overvalued, they'll sell it short. If the market comes down, they might come in for a quick scalp. In today's day and age, as Blair Holt said, the market is dominated by short-term traders. And then there's a 4th dimension, which are market makers and liquidity providers. And as Blair alluded to, the interplay amongst all these people in the market is not necessarily as deep as everyone surmises. For instance, the market maker is essentially trying to straddle the market and collect a small profit. But during periods of high stress, the market makers withdraw from the market, leaving it just to short-term traders and potentially panicked long-term investors, and potentially, eventually, panicked corporations who refuse to hire. So you can see, amongst all these four participants, both rational and potentially irrational behaviors, sometimes at the same time, sometimes at different times. All these must intertwine in this six-dimension catastrophe model to form some sort of deterministic outcome. And what it looks like is the next slide. Now, if someone can figure out what this means, come up to me later. But this is actually a representation of a six-factor parabolic umbilic catastrophe. And what it essentially means is that there's periods of stability, but constant periods where outcomes fold upon themselves in an endless series of events that are beyond the participants' comprehension and control. It's as if the market is in this endless quantum state between reality and non-reality. All us participants are captured in it. At some points, we're acting rationally. Some points, we're not acting rationally. And the interplay between all six of us, in my model, creates these endless folds and diffusions and sudden jumps and sudden surges, zeniths and nadirs. An interesting result for me, through my research of this, is that it actually means that modern portfolio theory and the efficient markets theorem hold at some points in the system. But at other points, they're suspended. Very interesting. It means that the probability functions of an options trader or a swaps dealer hold at certain times. But at certain times, the system suspends them and casts them away. Let's go back to my slide about Arena Pharmaceuticals. Okay, one more forward, sir. Right there. So I got this email from a guy. He said, Matt, what do you think about this stock? So as you see, there's written there some ideas. Some guy sent him a tip saying, hey, I bought this stock, Arena Pharmaceuticals, at 2. It's now 6. I'm a doctor and a physician. I highly recommend that you invest in these shares. Now, I invest in stocks for people like Procter & Gamble and Johnson & Johnson and the like, so a highly speculative company like this is something that I might observe, but is something, of course, I don't necessarily want to invest in. Everyone knows the story has become the most heavily traded issue right now. Go to the next page, please. So he sent me this. On the 9th, the stock was $6.60. I guess it went to 12 in the next couple weeks. So I was trying to be rational, but was I in the end irrational? Should I put all my clients' money into this stock and doubled it? I don't know. I really don't know. For me, no. Whether I was right or wrong, I don't know. Let's go to the next page. Finally, Monday, I had sent him an email saying, this is actually a really interesting case because I've been working on some ideas for a talk I'm getting. And on Monday, the stock opened at 12, and within 10 seconds, the stock dropped to $7.80. Like a mini flash crash in an individual securities market. Then it recovered finally. So as you can see, we have all the factors here in a highly unstable market. We have a corporation trying to get a drug on the market, locurcerin, that's going to work for people, potentially. We have long-term investors, this doctor, hey, this is a great idea. We have short-term traders bidding up the price to try to see what's going to happen. Finally, we have market makers trying to arbitrate the correct price of this on a daily fashion, and what we see now is a catastrophe exemplified in a highly unstable system that for no reason caused the stock to drop 35%, only to come back within minutes. So in conclusion, I think the takeaways from this are that your probability models and your valuation models work. But what you need to do is recognize the conditions of the market and the conditions of the participants in the market. And that, yes, indeed, there is a high degree of instability in the interplay between the participants and the market. And of course, it's been exacerbated by the failure of probability estimators used by everyone, whether it's a bank lending officer, a market maker, a corporation making investments, or even an investor, some seasoned investors who bought financial stocks as they kept on falling in the 2009 financial crisis. So I will take some questions.
Okay. Question for Williams.
So your very nice picture of the umbilical catastrophe theory model thing. How did you generate that? I mean, you had your ideas about the factors that might be significant, and then you showed us this graph. I mean, have you got some sort of parameterization of those factors? Have you got some data? Are you fitting values to what's happened in the past, or did you just make it up?
That's an excellent question.
Thank you.
You're
and
welcome.
what's your favorite band?
Well, I like the Beatles. I think they're very artful. The point of catastrophe theory is it can actually be used to detect black holes, but it is used not for probability forecasts, but to define potential and use it for more generalized ideas of how dynamic systems will work. It cannot predict the future. And what that parabolic umbilic actually looks like is this. It's just an endlessly folding surface of reality of market microstructures that sometimes converge into a singularity and stability and then quickly shift into another version of something else inside our market. Can you imagine that's what trading has been like over the last several years? How can a VIX future jump $1 in the last 60 seconds of trading on Friday, then open up another $1 only to fall with very little information? So as you can see, with catastrophe theory, you can think of a mathematical hypothesis that allows you to describe the catastrophe and the insanity of the markets that we're dealing with. You're welcome.
It's another question over
Yes,
here.
sir.
Speaking of VIX, because I just kind of saw some kind of really odd anomaly with VIX last week. There were a lot of stories, whether it was Eric Holder, whether, a lot of kind of potentially destabilizing stories, and VIX set their all-time record trading volume. And every time VIX sets an all-time trading volume, you usually see that the market is under stress and had a really bad week. The VIX was actually down, settled at 1811 last week, despite setting a record volume. I mean, what does that say to you?
Well, that's an excellent point and speaks to the divergences between the volatility of the market and the actual level of the market. And so those are two of my behavior patterns in my proposed model. And I think it's an excellent point. As a VIX trader, what you see is, in a sense, during periods of stress, you're in sort of on that what the catastrophe theory calls that cusp, that slope where all of a sudden you're in a somewhat stable point, but then anything can happen. And you'll notice that the VIX cash dropped last week to very steep lows of 18 upon the settlement. However, the futures bounded higher, and by yesterday, the cash tended to meet the futures at about 20.
Okay, we've got another question here. Hi, it's Arun Kaul from Olympian Capital. Question for you in terms of the share of each of the market participants. Do you see a level where there is some kind of equilibrium in terms of what each share should be, or do you see a tipping point where if one participant is too large a share, the entire system becomes unstable to a degree, and would you argue that's where we are today?
Well, I do argue that. I argue that the classic investors, corporations are out there doing their job, but they're not hiring. So, okay, that's a dysfunctionality. That's a market participant. There are investors that are too afraid to invest. They're putting their money into treasuries that yield just 1% or even 0. There's a domination of short-term trading and a discredit of long-term investment under these circumstances. So there's a domination, as you say, of market share of the short-term traders. And then finally, as Blair Holt described, the complexity of a market-making situation and the amount of information you have to deal with, where under the stress of toxic order flow, market makers will withdraw from the market and, as you see, create mini crashes in stocks like Arena.
Got another question here.
Amir Gilad from Context. Can you, and it's related also to the previous talk, you're saying market is changing all the time, and what time frame do you look at when you want to set a baseline and say the probability function has changed? Can you look 5 years ago and say, I'm comparing what's happening now to 5 years ago, or is it continuously changing and basically you cannot have a reference?
Well, that's a great question. As you see it in that artwork by Dali, the market has fallen essentially to a new state, a state of, in a sense, permanent lower expectations, especially for the return on investments. So before the crash, VIX futures, especially back-month futures, declined in value over time. VIX futures now in the back months are permanently higher. Before the 87 crash, there was no option smile. Puts and calls were priced equally. Well, after that event, option prices have always now skewed to puts. So I think we are in a new period, but there's a light at the end of the tunnel. I think for the classic long-term investor, you know, the middle-of-the-road people that I represent in my investment business, stocks are highly undervalued. You just have to get past the volatility. For traders, I think it's such an excellent opportunity to use to your advantage these microbursts and these fractures of market-making capacity to pick up stocks that are cheap or to purchase options on stocks that seem to be surging to unrealistic highs. And for market makers, which I am, it's not easy. You know, you have to contend with the costs of trading, the toxicity of order flow, and the fact that you're in a business where you take a lot of risk, you do a lot of trading, and you make sort of an okay living, but it's a lot of stress and pressure. So be happy that you're on the side where you can make intelligent trading decisions looking forward and hopefully using some of this talk to maybe plot where you are at in the system.
Fantastic. Can we give Matt a massive round of applause, please?
Thank you very much.